Imagine walking out of your house without carrying a wallet full of cash, yet still being able to buy food, pay bills, shop online, transfer money, and even run an entire business directly from your phone. Just a few decades ago, this idea would have sounded futuristic and unrealistic. But today, digital banking has transformed the way millions of people around the world interact with money every single day. From mobile wallets and online transfers to QR code payments and virtual banks, physical cash is slowly becoming less important in modern society. In many cities, people can now survive almost entirely without touching paper money for weeks or even months. This has led to one major question that economists, governments, and ordinary people are all asking. Is cash slowly becoming useless? Today, we are going deep into the rise of digital banking and exploring how technology is changing the future of money faster than most people realize. We'll talk about why digital payments are growing rapidly, how banks benefit from cashless systems, the hidden risks of digital finance, and whether physical cash may eventually disappear completely. Because this transformation is not just about convenience anymore, it is reshaping the entire global financial system. Let's begin by understanding what digital banking actually means. Digital banking refers to financial services that operate mainly through technology instead of traditional physical banking methods. Instead of visiting banks physically, people can now transfer money, pay bills, apply for loans, check balances, and manage finances directly through smartphones or computers. Mobile banking apps, online payment platforms, digital wallets, and internet banking services have made financial transactions faster and easier than ever before. Over the last decade, digital banking has expanded rapidly across both developed and developing countries. One major reason is convenience. People no longer want to stand in long bank lines or carry large amounts of cash everywhere. With digital payments, transactions happen instantly within seconds. Someone can order food online, send money internationally, pay electricity bills, and purchase products from another country without ever touching physical cash. Businesses also prefer digital payments because they are often faster, easier to track, and more efficient than handling physical money. During the COVID-19 pandemic, digital banking adoption increased dramatically around the world. People avoided physical contact and began relying heavily on online transactions and contactless payments. Many individuals who rarely used digital banking before suddenly became dependent on it for daily survival. This accelerated the global shift toward cashless systems. Younger generations especially are adapting quickly to digital finance. Many Gen Z and millennials feel more comfortable using smartphones for payments than carrying wallets filled with cash. In some countries, QR code payments and mobile wallets are now more common than traditional cash transactions. Governments and banks also strongly support digital banking expansion. Why? Because digital transactions are easier to monitor, record, and regulate compared to physical cash. Cash transactions are often anonymous and difficult to track. But digital payments create data trails for almost every financial activity. This helps governments reduce tax evasion, financial crimes, and illegal money activities more effectively. Banks also benefit enormously from digital systems because online transactions reduce operational costs. Maintaining physical bank branches, printing currency, transporting cash, and managing ATMs can be expensive. Digital banking allows financial institutions to serve millions of customers more efficiently with fewer physical resources. Technology companies have also entered the financial world aggressively. Many modern payment apps and financial platforms now compete directly with traditional banks. Some people can send money, invest, shop, and borrow entirely through financial technology apps without visiting banks at all. This has created a major shift in how people think about money and financial services. However, despite all the convenience, digital banking also raises serious concerns that many people overlook. One major issue is privacy. Physical cash offers anonymity because transactions are difficult to trace directly. But digital payments leave detailed records of spending behavior, locations, purchases, and financial activities. Banks, companies, and sometimes governments can potentially analyze this data extensively. This creates concerns about surveillance and financial privacy in increasingly digital societies. Cybersecurity is another growing risk. As banking becomes more digital, hackers and cybercriminals continuously target financial systems. Data breaches, identity theft, online scams, and digital fraud have become major global problems. Someone can lose access to money instantly through hacked accounts or online financial crimes. Unlike physical cash, digital systems depend entirely on technology functioning properly. If servers fail, apps crash, electricity stops working, or internet networks collapse, financial systems can face serious disruption. This raises an important question. What happens if societies become fully cashless during major technological failures or cyber attacks? Another concern is financial exclusion. Not everyone has equal access to smartphones, internet connections, digital literacy, or banking systems. Elderly individuals, rural populations, and low-income communities may struggle to adapt to fully digital financial systems. If cash disappears completely, some vulnerable groups could face major difficulties participating in everyday economic activities. There is also the issue of spending behavior. Studies show that people often spend more easily with digital payments compared to physical cash. Swiping cards or tapping phones feels psychologically easier than handing over real paper money. This can increase impulse spending and debt problems for some individuals. Subscription services, online shopping, and one-click payment systems make spending feel almost invisible. Many people lose track of how much money they are actually spending until financial problems appear later. Central banks around the world are now exploring something even more revolutionary: digital currencies issued directly by governments. These are often called central bank digital currencies, or CBDCs, unlike cryptocurrencies. These digital currencies would be officially controlled and regulated by governments and central banks. Some experts believe CBDCs could completely reshape global finance in the future. Governments argue that digital currencies could improve financial efficiency, reduce transaction costs, and modernize economies. But critics worry about increased government control and reduced financial privacy. If every transaction becomes fully digital and traceable, governments could potentially monitor economic activity at unprecedented levels. This debate has created intense discussions worldwide about the future balance between convenience and freedom. Cryptocurrencies like Bitcoin have also influenced conversations about digital finance. Others see them mainly as speculative investments rather than practical replacements for cash. Regardless of opinions, cryptocurrencies have accelerated global discussions about what money itself may look like in the future. So, is cash actually becoming useless? The answer is complicated. In many urban areas, digital payments are clearly becoming dominant. Younger generations increasingly rely on mobile transactions for daily life. However, physical cash still provides important advantages. Cash works during internet failures, protects some level of privacy, and remains accessible to people without advanced technology. The future may involve hybrid systems where both digital payments and physical cash coexist together. For ordinary people, adapting to digital finance is becoming increasingly important. Learning cybersecurity habits, protecting financial information, understanding online fraud risks, and managing digital spending responsibly are now essential life skills. At the same time, society must also carefully consider how much financial privacy people are willing to sacrifice for convenience. Because the rise of digital banking is not simply changing how people pay for things. It is changing how governments monitor economies, how businesses collect data, and how individuals interact with money itself. This transformation is happening quietly but incredibly fast. And many people may not fully realize how dramatically financial systems are evolving around them. The wallet of the future may not contain paper money at all. Instead, it may exist entirely inside smartphones, biometric systems, or digital identities connected to global networks. Whether that future creates more freedom or more control is something society is still debating. But one thing is becoming increasingly clear. The rise of digital banking is no longer just a trend, it is reshaping the future of money itself.